It is July right now, but honestly, it feels like April Fools. There was some news that came out today on a dividend stock that so many dividend investors love, Dominion Energy, ticker symbol D. This is a regulated electric utility. The news is that they are divesting some of their assets, their natural gas pipeline transmission assets, over to Warren Buffett's company, Berkshire Hathaway. And the deal looks so unfavorable for Dominion Energy that this stock plummeted today. And I just felt like, hey, is this April Fool's? Is this a joke? Because it just seems unreal. Now, whether you own Dominion Energy or you're like me, you don't even own it, today's video is really worth watching because there are so many lessons that all of us investors can learn from something like this. Because oftentimes, it's not about the investments that you make. It's also about the investments that you avoid. It's about avoiding loss, heartache, capital loss, and mistakes. And so I want to share on the screen with you right now. This is a quote from one of my favorite rappers of all time. He also happens to be a hero of mine, Jay-Z. And the quote that I'm sharing right now is from his track, Dead Presidents 2, and this is from the Reasonable Doubt album. I love this album. Classic. They don't make music like this anymore. I wish they did. But I listen to the old school. And so the quote goes like this: 3 shots, close range, never touched me, divine intervention. And I feel like this myself, because I'm talking about Berkshire Hathaway. And look, Warren Buffett, I wish you and your company all of the best. And I've avoided 3 of these potential pitfalls, just like Jay-Z. I avoided Kraft Heinz. I did a video about this a while ago, why I would not buy Kraft Heinz, because I felt that Berkshire's interests weren't necessarily aligned with my goals as a common shareholder, so I avoided it. Occidental Petroleum, I did a video, I warned everyone, I avoided it, because I felt, again, that Berkshire's investment in the company, in acquiring Anadarko and the type of preferred shares that they got, I just felt that their interests weren't aligned with mine as a common shareholder. Lo and behold, that thing was a horrible debacle, just like Kraft Heinz plummeted and was ill prepared for the financial and pandemic crisis of 2020. Lo and behold, we have number 3 now, Dominion. I avoided this one. Again, I believe it. I almost felt like, am I living in a fantasy world here? Is this April Fool's? No, it's not. It seems like it's real, but I avoid it. And the first 2 I avoided because of my due diligence and experience. The third one, quite frankly, Dominion, I think I avoided it just because of divine intervention, because I own a lot of the regulated electric utilities. I've got Duke, I got Southern, I got Hawaiian Electric, I got PPL, I got a lot of them, and I could have just as easily had Dominion. I did a whole video on it a while ago. I don't have it. I avoided it. I think that one was divine intervention, but my heart goes out to the common shareholder, the ordinary investor, who did get affected by this thing, because I think it is what is going down. It's not necessarily aligned with the actual people, the ordinary people at least, that own the company. I want to go through this case study today because it shares so many lessons, whether you own Dominion or not. And lesson number 1, I'll just foreshadow, is diversification. Stuff like this happens. No one could have seen this company coming. I avoided it because of divine intervention, like my man Jay-Z, but I don't know. I don't think it's possible to always avoid these types of situations. And so diversification is key. This is why I own 46 dividend stocks. Hey, everyone, please like the video today before we even get started. It means the world to me. Hit that thumbs up, that like button, leave a comment below. Do you own Dominion? Put in the comments right now if you do. Let's get started, everyone, with an exciting dividend investing video. All right, everyone. So I want to get started today with some numbers. And then after the numbers, I just want to get into some materials that Dominion shared with everyone today as a presentation. And I'm just going to go through it. I'm going to share insights as we go through it. So first thing, let's share some numbers on the screen. Check it out right now. And this is a snapshot, what you see of Dominion Energy. And Dominion is trading at a price per share of $73.59, and that is after it plummeted 11% in a single day. And so this very news that came out today, that they are selling their pipeline assets to Berkshire Hathaway, plummeted the stock 11% in a single day. Now, there was also another piece of news that came out in the same day, that there is this Atlantic Coast pipeline that Dominion has been working on with Duke Energy, a stock that I do own, and they are abandoning that project because of getting through regulatory stuff. It just does not look like it's happening. And so that was probably related, quite frankly, to the asset sale to Berkshire Hathaway. But I will note that Duke Energy was only down marginally today, and Duke did increase the dividend today. So we'll talk about that in a minute. But those were the two pieces of news today. The thing plummeted, and you're not supposed to see this kind of thing happen with a regulated electric utility. People invest in these type of companies for stability, and that is one of the lessons that comes out of the video today. Is in this stock market in 2020, the investor should expect almost anything. Anything can happen, and diversification is key, because something very unexpected like this could potentially happen. So the old earnings per share estimate, this is non-GAAP, but it's pretty close based on the press release that Dominion issued today. They did a PowerPoint that they released, is 443. The new EPS estimate is 350. So earnings at this company are going to be down by a staggering 21% because of this thing. And so that alone is really, really crazy. Now, we'll get to it in a minute, but even though earnings are down, they are going to shore up their balance sheet. The balance sheet is going to improve because they're eliminating some debt and gaining some cash with this thing. We'll talk about that in a minute. But earnings from an income statement perspective are expected to plummet, and then they will slowly rebuild over time. So that was very interesting to see. So also worth noting, the PE, the old one, if I take the current price per share and I divide by the old earnings estimate, was a 16 and change. The new forward PE is a 21 because they're earning less now because the company is divesting assets. 21 PE, I wouldn't touch it. So that's another takeaway. Well, I'll just tell you, like, I never sell. It's very rare that I sell a dividend stock. I buy and hold forever. But I'm willing to put up with a lot. I put up with a lot. And quite frankly, I'm willing to invest in anything, sin stock or not. Thug life investor here, doesn't bother me. But for now, as an investor, I will steer clear of this thing. Not for me, but I do wish everyone in the company all the best. I really do. But anyways, the PE is really high. To pay a 21 PE for something that has a bombshell, shocking announcement like this that sends this company plummeting, oh boy, I don't know. Maybe I'd be interested at a PE of 10. Anyways, the old dividend was $3.76. And here's what's so weird. They just raised the old dividend before any of this drama by a bunch in February. And they have a track record at Dominion of raising the dividend consistently over time. As recent as February, they just raised it again. And then all of a sudden here in July, they're like, psych, we're cutting this dividend, and we're cutting it all the way down to $2.50. And so they're making a massive dividend cut here. And the old dividend yield, and this is on the current price per share, is 5.1%. The new dividend yield all the way down to a 3.4%. Again, to pay a PE of 21 and to get a 3.4% yield from something that drops this kind of bombshell on all of us, I don't know. That ain't for me. And it's kind of sad because this was once regarded as a pillar of the dividend investing community. And it'll be interesting to see how other dividend investors react to this thing. So anyways, the old payout ratio was 85%. This was on the old earnings, by the way. I did that. And the new payout ratio on new earnings is 71%. So they are trying to improve things, they say, on the payout ratio. We'll get more to this in a minute. It's just fascinating. So that's a quick snapshot of what Dominion looks like, just basic metrics. I want to contrast that with Duke for a minute, because Duke is one of my favorite dividend stocks of all time. I love this. It's a ride or die position for me, a core holding. So check it out on the screen right now. And Duke is trading at $79.81. They were also involved in that failed Atlantic pipeline project. Anyways, they were down 2.4%, 2.48% today. Their estimated earnings this year are 5.17. Forward PE is a 15. So here we go. Pay a forward PE of 15 or 21 and pay it at a company that is doing really well, or pay it for a company that, quite frankly, looks right now like it's April Fool's. I don't know. And so for me, Duke is the easy answer, the easy selection there. That's just me. Anyways, with Duke, the dividend per quarter was raised today by 2.1%. So while Dominion cuts it, Duke raises it. It's up to 96.5 cents or $3.86 a year. The dividend yield at Duke on a starting basis is 4.8%. Payout ratio 74.7%. So really good payout ratio. Now, what I want to share also on the screen with Duke right now is something really cool. I started buying my current stake in Duke through a company called Progress Energy that was acquired by Duke, and now I own Duke. And the first kind of big tranche that I still own, that I bought in Progress Energy, that I hold to this day, that's now Duke shares, I bought in 2010. My cost basis is $44.37. If I take the current dividend per year, I divide by my 44.37, I get an 8.7% yield on cost. That's my simple yield on cost. That is simple yield on cost, not including dividends reinvested. That's pretty cool. And so that's an example of an electric regulated utility doing really well, rewarding the little guy, fending off just different interests out there, weird asset sales like what happened with Berkshire Hathaway. And I love it. I love you, Duke, and I'm really thankful for that. And I just want to compare and contrast these numbers because you see a few things here. You see a successful company with a lower PE, higher dividend yield, and one that's rewarded me with a great yield on cost. It successfully merged with Progress Energy back in the day, which was on its own a really amazing company. Contrast that with Dominion, where it's got a high PE, it's got bad news coming out, dividend being decreased. It's just a tale of two different stocks. It's just so interesting to see that. And so with that, and I'll tell you here, people think the market is efficient. It's not efficient. Just look at before your eyes right now. I think Dominion has more to fall, or Duke has more room to go up. One or the other. These stocks are not priced in the same world right now. And so all day, every day, I'd be buying Duke, hypothetically, obviously, for my personal situation only, just sharing my personal journey here on YouTube. And so I want to get in next to the press release, to the PowerPoint presentation that Dominion shared today, because I think there's a world of knowledge for all of us to learn out of that. Before I do that, I want to share with all of you really quickly that I do have a Patreon right now. I'll share a link to that in the description below and in the pinned comment. I put all of my best content forth here on YouTube for free, and I am upping the frequency of my videos these days. I'm working harder, upping my frequency, and I'm doing that with the hope that I will have support from the community on Patreon. And again, I'm not doing anything special or crazy for the patrons. I want to put everything here accessible for all, dividend investing for everyone right here on YouTube. But I rely on everyone's generous support on Patreon, and one can support me for as low as $3 a month. And the more and more support I receive on Patreon, it helps me do what I'm doing now, which is keep up this increased frequency and quality of videos. So if you want to see more of this, make sure to consider supporting me on Patreon. Thank you, everyone. Bless you all who are supporting me. It means the world. And if you haven't already, hit that like button. Please like this video, comment, subscribe. helps me out, means the world. Moving on, I'm going to share on the screen right now with all of you some of the data that came out of Dominion today, because it is wild. It is wild. It's like April Fools. And so first, let's just summarize. They're going to divest substantially all their gas, transmission, and storage segment assets to Berkshire Hathaway Energy. Great. They're going to convey over a bunch of debt, 5.7, so that is a good thing. Although keep in mind that interest rates are at historical lows and they're probably not going up anytime soon. And historically, regulated electric utilities have been really good about passing on increased costs to customers. And so having debt at a regulated electric utility is not such a horrible thing in my opinion, but it's always good to have a better balance sheet. So there's pros and cons here. But simply to eliminate debt, this wouldn't be why I would do something like this. The only reason you divest these assets is if you thought, one, they might just be a huge liability in the future, kind of worthless, and you're getting a good deal for them or something, or you're just making wacky decisions. And so the cash that they're getting for this is only $4 billion. And what's so funny is if you look in the footnote down below, I have an arrow at the bottom of the screen that I put in there. In the footnote, it says $1 billion of the cash will be used for taxes. So there's only going to be $3 billion yet. And what are they going to do with the $3 billion? They're going to use it to buy back shares. This is what I'm saying. This is why I called it a bit of a joke, because some of this, I'm not trying to insult Dominion, by the way, or the shareholders. I wish Dominion the best. Gosh, I do. And I wish this weren't the case, but I don't know if someone was trying to be comical when putting together this deck. I'm serious. I'm surprised that this deck got released. And I'm going to share more as I go through, but I don't get it. But anyways, they're going to make $3 billion cash and buy back a bunch of shares. They're going to extinguish some debt that's at already low interest rates, and with rates headed lower, and with rates, quite frankly, not mattering for a company like this because they provide regulated electricity and can raise cost of electricity through the government, and they have a monopoly on their markets. And so anyways, moving on, they anticipate to close this thing in Q4 of 2020. So that's an overview of the deal. I want to move on to the next slide now. And on all of these slides, I have an arrow next to the things that really stand out to me. So check it out. I'll share the next one now. And what I see in the next one is this is why I'm calling it a joke. The headline at the top, it's an opportunity for significant long-term value creation for shareholders. You're going to tell, me, a shareholder, I don't own any, but I'm speaking hypothetically, if I were a shareholder, that you're creating value for me by selling off some really valuable assets at bargain basement prices and cutting my dividend, and the stock is plummeting 11% in a single day. You're creating significant long-term value. It's the message is not aligned. It's just not aligned. And so that's something first that I notice on this slide. What else do I notice here? Significantly increases long-term earnings growth rate. I don't see how that is possible. What they are doing is they're getting rid of their pipeline business. I like the pipeline business, quite frankly, because it involves natural gas. Natural gas is largely considered clean energy. There's something good about being in that business, and you'll see later in the same deck, they highlight themselves as a clean energy company. And so if you're a clean energy company, green energy company, why are you getting rid of the very assets that help you live that brand identity? And so, anyways, though, I don't understand how getting rid of that and then buying back a bunch of shares significantly increases long-term potential. That just seems wacky. And the last thing is they're saying they rebase their dividend to reflect the revised model, peer-aligned payout, increased growth rate. You're telling me this is an opportunity for significant long-term creation. You're telling me that the growth rate of the dividend is going to increase, but it's going to take years just to get it back to where it already was because you're debasing it so much. And quite frankly, a payout ratio, they're citing, we want to be in line with other people in our industry. I don't know. I don't know about that. I just look at Duke, and it's a different situation, well-managed company. And so anyways, there are some things on here that are good. Like, their credit profile, balance sheet. Yeah, they will be better without all that debt. and so they're going to narrow their focus, be more focused. I don't know if that is good, quite frankly, because one of the things that attracted a lot of people here in the community to Dominion was the diversity of the company, and now they're going to be more focused just on the regulated electricity, and so pros and cons there. Moving on to the next slide, and what you see here is just the annual guidance is way down. And so the reason the guidance is down, the midpoint from 443 to 350, you could see their core business at the top is the same. Their contracted assets goes up a little bit, but it's the bottom. It's the gas transmission and storage, which I thought was a really good business that attracted a lot of people to Dominion. They basically lose all that. And that's what I'm saying is to eliminate $5 billion in debt, which basically you can carry debt these days for nothing because of low interest rates, and I don't think that's going to change anytime soon. And for $3 billion in cash, because $1 billion of it goes to taxes, shareholders are losing a staggering $1.12 to $1.21 in EPS. That's just doesn't seem like a good trade-off. Now, it does say here it's inclusive of ACP, and ACP is that Atlantic Coast Pipeline, which has failed. And so, to give them some credit and to be fair here, maybe there's more than meets the eye here. Maybe this Atlantic Coast Pipeline thing was heavily factored in to their guidance, and because it is failing, maybe that triggered an event where, look, they just had to do something. But by contrast, it didn't seem to hurt Duke too much, and so it just seems like Dominion is facing, if that did hurt these guys, they're facing the bulk of the pressure from that. And so, to be fair, it could be because of that, because it seems like there's laws that have been passed that basically make this Atlantic Coast Pipeline not be able to go through certain wetlands, and maybe that's the story. Maybe that's what's really happening, and maybe they're navigating the situation as best as they can. So I do want to be fair and unbiased here. I know I'm harping on these guys a little bit too much. I love you, Dominion. Much love for you. I wish you the best. But anyways, that's the other way of looking at it. So moving on to the next slide, I want to talk about this. So they give a slide here on what's going to happen. EPS is way down. And what's it going to take to get it back? They're basically saying they're going to see 10 to 11% growth after the first year, and then thereafter 6.5% growth per year. And so what I decided to do was take this and run a little model in Excel. So I'm going to share my Excel model on the screen right now. Check it out. And what you see in this Excel model is I have a baseline. Their EPS is now down at 350, and in the first year, they're going to actually grow it by about 11%, 10.86. So that gets it up to 3.88. 2022, it'll be up to 413 if they grow it by 6.5%. Then if they grow it by another 6.5% in 2023, it'll get up to 4.4. And right now we know that the old 2020 EPS was 4.43. And so what the data on the screen shows you right now is that by 2023, they're going to be back basically to where they should have been in 2020. And there's kind of a tale of two things that could have happened here. Basically, we lose 3 years. Investors in Dominion lose 3 years, and that's really sad when this is already a wacky year with the pandemic. And there's two things that could have happened. Either they made a really bad deal. That's what the street thinks. That's why the share price is down with Berkshire, and Berkshire made a good deal for themselves. Or this ACL, this Atlantic Coast Pipeline, really hurt them. They had to divest the assets, and it'll take them 3 years to rebuild from the laws that won't allow the pipeline to go through wetland. And so that could be something that happened as well. But it's just interesting to see here that, long story short, Dominion shareholders are set 3 years back because of this thing in terms of EPS. And that's based on their forecasts. Of course, it could take shorter or longer. And so with that, I want to share the next slide on the screen right now. And in the next one, what you see is, again, I just feel like some of these things they say on the slide should have been thought through more. They're saying there's going to be accelerated dividend growth. Of course, there's going to be accelerated dividend growth if you slash the dividend from an estimated 345 to 250. And that 345, by the way, includes a fourth quarter this year at the lower rate. And so moving on, I'm going to share one more, I think, one or two more. Let's see. No, this is the last one, actually. And what it shows is, again, a summary. I just think there are a lot of things in here. Their clean energy profile. How does this make them any more clean energy? I don't know. Increased long-term earnings and dividend growth. I don't understand how buying back $3 billion in shares and losing a huge chunk of EPS is going to make it better in the long term. I don't get that. And narrowed focus. Hey, and it says it enhances consistency and transparency. These slides, it leaves more questions than answers. And so with all of that, going back to my point, I diversify. I have 46 stocks. People give me a lot of flack for it here on my channel on YouTube. They tell me I own too many stocks. This is why I do it. I could have never anticipated something like this. Like I said, it was easy for me to avoid KHC. It was easy for me to avoid Occidental. It was divine intervention that I avoided Dominion because it looked just fine to me when I analyzed it a number of months ago. And I'll link to that video in the description below if you want to check out my analysis from back then and all the great community comments from back then. But I don't know. It's just so wacky what is going on with this company. And so where I stand right now, I am very pleased with the regulated electric utilities I own. I love having them. I own PPL, I own Southern, I own Duke, Hawaiian Electric. I'm fine with what I have. I am actually at this time, because of all of this, Dominion was on my watch list. It is off the watch list. This is just kind of deal breaker territory for me. And personally, if I were a shareholder, I'd be on the phone with investor relations, just trying to seek answers, get more answers to all of this. And anyways, share in the comments below what you think. Do you own Dominion? What do you think about all this? Does it seem wacky to you as well? If you do own Dominion, hopefully in partnership between investors, management, board of directors, everyone can sort this out and set the company up for success in the future. So tough love, y'all. I hope you at Dominion turn it around. And Buffett, Berkshire Hathaway, picture me rolling. So with all of that, I love you all. Thank you for watching the video today. Before I leave today, in terms of full disclosure, I own the stocks mentioned today. I am long Duke, ticker symbol DUK, Hawaiian Electric, ticker symbol HE, Southern Company, ticker symbol SO, and PPL Corporation, ticker symbol PPL. Also, in terms of a disclaimer, friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Possible to lose a lot of money in the stock market. Possible that my analysis is flawed. I am just sharing my journey here on YouTube for fun and entertainment. And I love you all. I hope you enjoyed the video today. Please subscribe, like the video. Check me out on Patreon if you want to see a more frequent content. Support means the world to me. Love you all. I will see you in the next dividend investing video.